Hi, thanks for watching. Today I'm going to explain how energy prices can drive the yield curve and greater fixed income markets. So, first of all, yields aren't magic. When you enter fixed income, you see paragraphs of just jargon, you see formulas you don't understand, and it's easy to assume everything's a black box magic. But fundamentally, the UST yield is simply financialized dollar inflation and real growth rate, or the yields you'd see on the tips. Energy remains the largest sector, commodities driven sector even, that can impact both real growth rate you'd see in industrialization and financialized inflation. And I'll get to that, how it can impact credit markets as well. Simply put, when oil moves, it moves the whole economy, and yields, not being this kind of just magic number traders choose, but a reflection of both financialized and growth rate inflation, structurally are very tied to energy. And this image shows right here, you can see oil. It's a very, very simple image, but oil tied to the credit markets, lending markets, consumer sentiment, especially at the pump, minerals markets, even how minerals are processed in industrialization. So the yield curve and the crude curve intersect a lot in the Treasury's futures curve plus the crude curve as well. So I use the word liquidity monster. It's not very a professional word, but it describes it perfectly because the crude curve reacts violently, almost instantly, and very efficiently at sometimes to supply chains, repricing, geopolitical shocks, wars, even just supply and demand or OPEC reasoning. What you can see is within the futures ecosystem, crude curve can drive the treasuries curve. You can see the front to next month contracts kind of lose their parity, lose how they're efficient trading. You can also see this impact the VIX index and index futures calendars. So they can separate a lot more than simply the richness and cheapness to their financing, but they can start to price oil a little bit as well, which has major consequences for equities market makers. Right here, I'm showing the price of crude. If you've been trading recently, you probably recognize that chart. Just skyrocketing. You can see the UST Treasuries curve. It's starting to reprice as well. And you're starting to see the yield curve structurally tied to the financing of the Treasuries market on the, especially the ZN, ZB contracts. That's also going to reprice as well. And that bottom part shows the crude moving, impacting UST futures repricing, and finally the yield curve itself moving on that. So you can see liquidity wise, it's not this abstract thing where you're scratching your head, you're thinking, why is this energy price moving it? Is this just some weird reflexive textbook example? But you're seeing in real time on a real trading desk, people are watching oil and its curve move, and they're going to reprice the implied financing rate on the treasuries contracts, and the yield curve will structurally move on that as well, especially when cheapest to deliver baskets start to reprice as well. Another point I want to make is energy lasts with real impact. So this isn't just a reflective scare and then we move on to the normal economy like some narratives can be on CNBC headlines and other examples. So it's not only just reflexive, but consumer spending at the pump, petroleum-powered trade routes, ship routes, airline costs, minerals industrialization, even credit card solvency have massive, high correlated impacts with the price of a barrel. Credit, like venture capital lending, corporate bonds, unsecured overnight credit lending, also directly tie to the energy market. So when energy prices are distorted, whenever there's a geopolitical shock, this isn't simply something you're looking at to scare you for a week and then you move on and you talk about some cool earnings. This is something that's going to last quarter by quarter. You're going to see the worker, you're going to see credit cards start to get impacted. And without a real geopolitical solution or a real Fed solution, this can start to change how the entire economy works. Right here I'm showing an energy price. It can cause a distortion in even credit spreads. So the high yield to investment grade spread, Bank of America, you can look at it on Fred if you're interested. It will tie very closely to a crude shock. That's going to have impacts on your overnight lending, on your balance sheet when you have commercial paper, and even liquidity tightening can happen because of oil, not even just tied to the Fed's reaction, but the literal credit spread widening is going to tighten lending. And if you are interested in venture capital, whether you're lending or whether you want to start, you might want to watch at the energy markets, because that's going to massively affect the ease of capital you can get. Sometimes I'm talking to people in the Bay Area. A lot of these tech startup guys go, the calm energy after the global financial crisis, a little period of calm energy in the 2010s, really actually helped tech startups. So it's really fascinating how structurally deep oil shocks can go. Energy pricings are unavoidable, and this isn't just a yield curve moving, this isn't just credit spreads widening, but almost every single aspect of the economy is tied to the price of energy. So when oil moves, it's unavoidable that the economy will reprice to it. So if you're a bond trader, you've got to be watching oil, because every single aspect, it doesn't matter if you're in high yield, it doesn't matter if you're an investment grade corporate, treasuries, munis, everything's going to be moving on energy narratives, especially now with this Iran situation happening. And I'm even showing right here the cheapest to deliver basket can have switches on energy shocks, especially with our most recent shock we've had right now. You're going to see implied optionality become a factor. You're going to see how easy that overnight collateral gets when SOFR starts to mess up. And you're going to see the bid ask on cash treasuries even widen somewhat on energy shocks. So that's my main focus, is kind of the transmission of the basket to the futures right now, but you're even seeing that really structurally important aspect of the economy getting changed on oil shocks as well. And final conclusions is an energy shock is not just moving the textbook price of a curve. It's impacting the liquidity, it's impacting the ease of capital, which can have unpredicted consequences on the bond market. Credit, corporate bonds, and VC lending is impacted by this as well. So this isn't just a boring treasuries trade. Those that are in kind of corporate arbitrage land are also going to see their balance sheets impacted by this. The central bank across the world, Eurozones, Bank of Japan, the Fed in America, are going to have their hands tied on an oil shock as well. So even if finance, even if some economists argue the best move would be to hold rates flat, you might have to see hikes just to protect the consumer. And finally, CPI doesn't lie. Well, it does sometimes, but it was an easy statement. It can become a gas station index for long stretches of time on an oil shock. And going back to that previous point, you're going to have the Fed moving repo pretty much having their hands tied on an oil shock. Anyways, thanks for listening. I was just explaining a few concepts, and I'm mostly describing what I've seen in real life. Like when I'm on Thinkorswim and I'm watching the crude and Brent curve, this thing is directly moving with interest rate spreads. It's directly moving with credit spreads and treasury calendars. And it's one of the most important concepts of protecting your balance sheet from crude, Brent, gas, and other energy product shocks. Thanks for listening, and I hope you have a great rest of your day.